Okay, so my name is John Vance, president and or I guess now CEO and founder of Vance Wealth. Today is our annual tax planning webinar where we're going to go through personal and business tax planning strategies. So just as a reminder, I'm a CFP, Certified Financial Planning Professional. I am not a CPA. I'm not an accountant. So while we are going through tax planning, this is not tax advice. I do have some disclosures here that covers that. But I think anytime we talk about tax planning, these are strategies that should be reviewed with your team. These are strategies that, you know, if we're your advisor, we're helping you implement, but it's always a team and a collaborative, a collaboration with the appropriate professional. So again, we're going to go through a lot of ideas here. Some of these are going to pop out to you and say, hey, these are things that I'm already doing. These are things that are interesting that I want to start doing on a go-forward basis. And just make sure these are things that you collaborate with your team, because I know we have some clients on this, some prospective clients and some professionals. And so this is really a breakdown of what our topics are, for today are going to be. We're going to go through and understand the current landscape of what's happening regarding taxes. And then we're going to go through planning considerations and strategies for personal tax planning and then business owner related tax planning. One of the things you'll notice is that we have transition slides as well as some title slides, and we're going to utilize that because it's going to help us format breaking this into smaller sections. Because again, I know this is a lot to digest. If any of you are going to brave, I don't think we're going to be on here 90 minutes. I hope not. I think probably about 75 minutes. So there's a lot of data as I was preparing this. I wanted to bring the full scope of a lot of the things that we're reading about, we're hearing that impact you. And then also we wanted to have this available so that, again, you can share this or something that, you know, if you can't stay on for the entire webinar, you can access later. So we got lots to go through, and I'm going to keep an eye on questions. One of the things just to know that's difficult is everyone's tax situation is different, and I want to be mindful of that. So depending on how we work the cadence, if you do ask questions, it will show who you are, and that might even be an item where we get back to you with an email tomorrow. Okay, so understanding the current landscape when dealing with the tax environment. So one of the things that's actually been a reality is that we've actually been in a fairly favorable tax environment. Now, the reality is nobody wants to pay too much in tax. They want to pay whatever, I guess, their fair share is, whatever that means. But the reality is we've actually been in a fairly low tax environment. We've had lower marginal rates over the last 7 years since the most recent tax changes. But that also came with scaling back some of the popular deductions, which actually meant that a lot of people now do not itemize their taxes. An issue that used to come up 8 years ago prior to the changes was that a lot of higher income earners were subject to alternative minimum tax, which is really no longer an issue. And then they also, the government set up an environment where there was very favorable estate and gift tax environment. But the question is, what about the future? Because we know there are some things on the horizon that are going to change. And really that change is around the uncertainty on tax rates after 2025. So we're in the tax year of 2024. Tax deadline was yesterday. So many people got their taxes done. Many are still on extension. But some of the planning we're going to talk about is how to utilize the best planning techniques for 2024 and 2025, just while being mindful of what's on the horizon in 2026. So lots of data on here. So I do want to apologize in advance. When you get into a investment-heavy conversation with me, a tax-heavy conversation, the data tells the story, right? Because taxes, there's a lot of rules and there's a lot of numbers and there's a lot of percentages, right? So the reality is these are some of the key tax figures, and I am going to do my best not to read through all of this. This will likely be a nice resource if you want to come back and follow some of these items or get more into the weeds. But I want to make sure we go through this with a level of pace. And sometimes it's like drinking through a fire hose because there's a lot of information coming. But I also just want to be mindful of trying to cover topics at a high level, but enough granularity that can help you make informed decisions. So you can see the ordinary income tax rates. Those have not changed. Long-term capital gains rates still at 0, 15, and 20% federally. We are still looking at a net investment income surtax for single and married filing jointly of 3.8%. The standard deduction, which is the basically the deduction you get off your adjusted gross income if you are not itemizing. For single tax filers is a little bit over 14,000, and couples, or I should say married filing jointly, is 29,200. The SALT deduction, which is the state and local tax deduction, this is where you deduct California income taxes if you live in California, your property taxes. That is still capped at 10,000, but this is one of the provisions that's going to sunset here in a few years. Mortgage interest deductions still capped at 750,000 of aggregate debt. And then a couple things at the very bottom: maximum salary deferral to your retirement plan. So the amount you can put into your 401k, 403b, 23,000, and if you're over age 50, 30,500. The maximum contribution to your IRA has increased to 7,000 and 8,000 if you are over age 50. So a couple things too that I want to go through, because again, we're covering the current landscape, is regarding estate taxes and gift taxes. So right now you can see the second number down on the left says $13,610,000. That is the current, as of 2024, lifetime gift and estate tax exemption. So that means if you die, that is the amount that of your estate up to that limit where you do not have estate tax, a federal estate tax. It also says lifetime gift. So you have the ability during your life to give away assets up to that level and not pay any gift taxes. Now, there's some complexities around those, but that's generally how that works. If you are over that as an individual, then essentially your tax rates are around the 40% federal estate tax rates. The third number down shows $18,000. That is the annual gift that you can give to as many recipients without resulting in a taxable gift. So that $18,000 can be given to friends, children, grandchildren. That can be given out, and you do not have to, it does not result in a taxable gift nor a gift tax return. And then the fourth component of what estate taxes look like is portability. They put some, there are some changes in the code that allows a surviving spouse to utilize the deceased spouse's unused exemption. So what that basically means, going back up on this chart, that $13 million, if you're a married couple, you multiply that by 2, so that means your exemption is north of 27 million. So you can see for estate taxes, I know we live in a wealthy state here in California, and there are a lot of large estates, but by them increasing that estate exemption, it really has made it a select group of people. When I first started in the business back in the late 90s, the estate exemption was $600,000 and 1.2 million. So a lot of people ran into estate tax issues, and at 27 million, it's not hitting in most households. Okay, so the next thing we want to go into is this idea of what a tax planning philosophy. I do think this is a little unique here to us at Vance Wealth, of really embracing this idea of, well, what does it mean to have a tax planning philosophy? Because the reality is, if we are a high earner, we're building assets, our net worth is increasing over time, and that might be through your W-2 wages, it could be through owning a business, it could be through just being a great investor. The reality is you're going to pay tax, and that's part of the deal. And while we recognize you're going to pay tax, we need to be smart about paying tax. And so part of our philosophy starts here. So I listed these 3 bullets out here because this is really what we live by. This is the planning that we try to help our clients with, is focus on your lifetime tax liability. Now, we don't know what the future is going to hold for everyone, but when we build a financial plan, let's say a 30-year financial plan, we have a sense of what cash flow is going to look like for a client, what their income is going to look like for a client, more importantly, what their taxable income is going to look like for a client. So if we can make good decisions to basically good decisions with the idea of focusing on how do we limit our tax liability over our lifetime. And this would be different than the idea of how do I save taxes today in this current year. So we love the approach around focusing on your lifetime, not in any one given tax year. I think that makes us unique. The next bullet point there is attempt to smooth out income volatility, right? So the reality is sometimes people have variable income. And, so that means sometimes they're on a higher tax rate, a lower tax rate. And we find that it's one of the best things we can do is if we can smooth that out, albeit maybe at a higher rate, but if we can smooth that out, that will help us manage some of the ongoing tax planning. And then embrace paying taxes at lower rates. So that's one of the things that we recognize at some of the lower end. There's a 10% bracket, a 12% bracket, a 22, and a 24. We consider those low rates on a historical basis. And so we do embrace the idea of, you know what, sometimes it's just better to pay tax than to defer the tax, because that's where like retirement funding and a lot of different vehicles, they don't avoid the tax, they defer it. And so sometimes it's just better, let's just pay the taxes now at these lower rates. And a couple ways that we utilize or that we take advantage of this is consider using Roth IRA or 401k accounts, and then also consider partial Roth conversions. And we'll get into that a little bit more as we go deeper into our conversation today. So the tax challenge. So when you look at this, there's really these three buckets. Tax me now, tax me later, don't tax me again, right? This idea that, okay, we know tax me now is, mutual funds, CDs or money market accounts, real estate, right? When you're getting income off of those, you pay tax today. Tax me later are the vehicles that you put pre-tax money in, so you get a deduction, and things like traditional 401k, IRAs, SEP IRAs, 403bs, 457, these types of retirement plans, these are tax me later, right? You put the money in, you get a tax deferral, the money grows tax deferred, and when you take it out, you pay tax. Again, tax me later. And then don't tax me again are different vehicles around life insurance, municipal bonds, bond funds, Roth IRAs, and Roth 401ks. One of the things that you notice on here, there's a bunch of disclosures, number 4, 5, and 6, which is, I know, a little bit hard to read. But the don't tax me again, sometimes we'll call those tax-free, but there are some caveats. So it's not always as clean as these are completely tax-free, because they're not. But for the most part, they have this don't tax me again structure. And the reason why I kind of highlighted here and had a picture of the White House is you look at, well, these vehicles here, tax me now, tax me later. This is how government gets some of the funding from a retirement perspective. So when we recognize that there's the tax challenge, right? We've always talked about with clients like building your different buckets of wealth with different types of accounts, right? So those three, if I just go back, those are three different buckets that most people should have, right? You're going to have the taxable accounts, the pre-tax accounts, and the Roth accounts. And the reason why that's relevant is as you start getting older and closer into retirement, which I would define kind of this window of age 55 to 75, is that really becomes an ideal planning window. I can't tell you how often people will come into our office for the first time right around this age of 50, 55, and we get excited because we know we're going to be able to make a really good impact from a tax perspective, because there's so much planning that's available that's somewhat complicated. It takes a decent amount of planning and understanding all the code, but this really is the best window. So, and the reason for that is you're prior to your RMD requirements. So, when you have to take money out of your retirement account during this window, this is basically pre-RMD requirements. Prior to maximum Social Security age, right? So we know you're not eligible for Social Security till 62. Full retirement right now is age 67, but you can also wait to age 70. So prior to the Social Security age, you have this window where you could force money out of your accounts and not exacerbate tax liability when it comes to taxation on Social Security. And then the third part of this is if retired, you're likely in a lower tax bracket. So if you had this entire working career where you were in a higher bracket and you deferred money into a retirement account, now that you're in retirement, it could make sense to start converting, doing different things, because if you're in a lower tax bracket, you might be able to move the money at a lower rate. So again, this is really the ideal planning opportunity. And again, I think it's not an accident of why people find Vance Wealth around this time. I would tell you the majority of people are coming in our office kind of 50 to 55, empty nesters, really looking for some guidance on, okay, I don't want to work forever. How do I actually put together a strategy for my financial plan, but also how do I pair in a good tax planning strategy as well? Okay, and I do apologize. There's a bunch of these that have a lot of data on here, and I'm not gonna make you an expert on all of this, because this would be way too much to absorb. But there was Secure Act 2.0 that came out that just changed a bunch of rules around retirement. They increased the required minimum distribution age. Back in the day, it used to be 70 and a half. It's now 73. They increased catch-up contribution. They expanded Roth contributions. They eliminated RMDs for Roth 401ks. They allowed you to move 529 college account money over to Roth IRAs, right? So there's a whole list of all of these things that were put in place to hopefully improve incentives for people to save for themselves and just make it a little bit easier to navigate. Excuse me, these were the key provisions of Secure Act 2.0. I'm going to highlight a few where we see probably the most questions that we get from clients and things that are most relevant to our clients. Retirees can delay drawing down their retirement assets. So this is all based on when you were born. So RMD age, you can see on here on the right-hand side, age 72 now if you were 1915 earlier. And frankly, if you were, if you reached 70 and a half prior to 2020, that was your RMD age, but you're already in the middle of that. If you were born between 1951 and 59, your RMD age is 73, and 1960 or later, you're 75. So this is really important, right? Because this is when you have to take money out of your account. And the reality is when you first have to take money out of your account, you have to take out about 3.5%, a little bit more than that. So you don't have to take it all out, but you have to start taking money out. And when you're required to take that money out of your retirement plans, that creates ordinary income, which creates more taxes. So that's why this is really important because, yeah, you can delay till a later age, but you want to be thoughtful about delaying. Another item on here that's really important, I got really excited about this one, is what happens, because we get this question all the time. All right, I save for my kids and they're 529, and what if we have unused money? What if they go to college, they still have reserve? What happens to that money? So there's some nuances to this, but the long and short of it is that up to $35,000 per beneficiary in the 529 can be transferred to a Roth IRA in the name of the beneficiary. So basically in the name of your child, not to yourself. So it can be transferred. Now, the rules around contributing to the Roths, the limits on contributing to the Roths still prevail. You can't move all $35,000 at once. So I mentioned earlier, the eligibility for 2024 is $7,000 per year. So if you can move up to 35,000, you can move it in chunks. So you can move it each year. But again, the beneficiary still has to apply and there are income restrictions. There's some notes on here as well that I don't necessarily need to go into all the details on, but this is a really cool function as well, because for our parents who start saving right out of the gate, meaning when their child's born and they have that money in this plan all the way through college, that's, sometimes 22 years. And when you have resources left over, it's nice to know that money can find a home. So that was definitely a nice addition to the new Secure 2.0. Okay, well, this is a big topic, right? Risk of higher taxes. I think the reality is we know in Washington, we have some challenges, right? And I'm not here to unpack those. We are in an election year, so I do plan on doing an election update as we get into the fall. But this one is just talking about the risk of higher taxes, right? We would be naive to not look at this saying, you know what, are we going to have some higher taxes? Probably. Number one, we have legislative efforts on Capitol Hill. So number two is the expiration of the tax provisions at the end of 2025. So when Donald Trump put in the Tax Cuts and Jobs Act back in 2017, they put in the sunset provision that basically without congressional action, these tax provisions will sunset. So, and when they sunset, we're going to have higher tax brackets. So that's the whole risk here, is that without action at the end of 2025, so a little bit over a year and a half, this will sunset, and then these tax provisions, or what I would call tax cuts, expire. So there is a risk of higher taxes in the future. Then number three, fiscal pressures facing the federal government. The reality is we're spending a lot of money. I think the last number I saw is something like $1 trillion we're borrowing every 100 days. Obviously not sustainable. So are we going to control spending? Are we going to tax more, or a combination of both? I don't know the answer to that. But the reality is we definitely have some fiscal headwinds here that are going to potentially cause some higher taxes. So we can all hope that we have some restraint on spending, but frankly, for the last 25 years, we really haven't seen any sort of restraint on spending from either side of the aisle. So a couple of things just to highlight. Given that we're in a higher interest rate environment, so we're going to kind of look through each of these boxes. In the top left, you can see here it says 90% projected increase in interest costs on federal debt over the next 5 years. The reality is that number is so big because rates have gone up substantially, more than doubled on the short end, especially. And then also we're borrowing more money. So we're seeing massive impact on the budget deficit, and then obviously the interest expense. On the top right, you can see 70% of government spending is devoted to mandatory programs plus interest. Doesn't leave a lot for other programs. So you can see that's definitely a massive pressure that our government is facing. Bottom left-hand corner, it shows that based on our current tax structure, that we're estimating about 18% of basically 18% of GDP will be collected in revenues, but we're spending 23%. So we have a gap there of 5%, which again, either spending has to come down or revenue's got to go up, or we're going to keep borrowing money, right? So the reality is, you guys probably know my opinion. I'd like to see spending come down, or at least, kind of pause and let our revenue start to catch up with it. And then this is not a big scary thing for me. It was just part of a slide that I had found, but that says Social Security Trust Fund will be depleted in 2034. The reality is we have a printing press. I don't think there's a big risk of this. Again, in my humble opinion, but nonetheless, that is the data. We have plenty of ways to solve this, but politicians do not seem to want to tackle that issue. Okay, so I mentioned before the sunsetting provisions of the tax code. And so this headline here says 2026 tax law changes. I want to be careful with this. This is not a mandated change. So in the absence of Congress, the president agreeing to a new tax policy, we will sunset and revert back. If, however, once we get through the fall and we know who's in control, we might be able to put together some new tax policy that helps our country run for the next 5-10 years. But in the absence of that, these are the changes that are coming. So I want to make you aware of that, because given how divided our government is, it's likely a split. And when we have a split, it's hard to come to an agreement. So this is what's on the horizon. Again, not in 2024 or 2025, but in 2026. So as we go through all this, I'm sure whatever screen you're watching it on this is probably a little bit hard to read, but basically I just want to emphasize what's happening is the Tax Cuts and Jobs Act, which is the TCJA. They are set to expire on January 1st of 2026 unless extended. And basically the gist of it all is that we're going to have tax rates are going to increase, but there's also a series of other things that are going to occur. Many of you who are clients who've seen this chart, we show it to you when you come into the office. I'm going to focus here in one area on the right-hand side. You can see this bright yellow where it says 24%. In 2024, the 24% tax bracket goes up to over $383,000. So the reality is the 24% tax bracket is a really big tax bracket that benefits a lot of higher earning Americans. But what you can look at is to the right of that, which is kind of like an orange or brownish color. You can see that the old brackets that kind of that were in this income range were 25, 28, and 33. So you can see the reality is because of the tax changes, those that are in the 24% bracket today, with the sunset provision, depending if they're at 200,000, they would be at the 28% bracket. But if they're closer to 400,000, they would be in the 33% bracket. So imagine that you were at the 24% bracket, and now you found yourself in the 33% bracket at the federal level. That's a massive change. So these are going to have some real impact on people's take home. But there's a lot of provisions that also change as well. So it's not an easy analysis, but it's definitely one that will be on our radar. The good news is, and I don't know if the politicians had this foresight, but the good news is we are having an election in the fall, which means we do have all of 2025 to plan. So depending on the makeup of our government, we'll be able to plan in 2025 with having hopefully a little bit of clarity of what's going to happen. But I also know the government is famous for waiting to the last minute. So we'll see. I'm not going to hold my breath, but we'll plan accordingly, which is going to keep us really busy this next 2 years, making the right decisions. And then, you know what, we're just going to have to react to what happens, because the reality is whatever happens, and we don't have control of that. And I apologize if this is a little bit hard to read, but the 4 big income tax issues that are going to change. Right now, the standard deduction for married filing jointly is like $29,000. Prior to this change, the standard deduction was basically half that amount. So actually, that's why we used to only have like 47 million that would actually itemize deductions, and now it's only 18 million because the standard deduction is so much higher. So that's going to revert back. The deduction for state and local taxes, so that's capped at $10,000. Well, a lot of us in California pay a lot of California income tax plus high property taxes, and so this might be a welcome relief if you get rid of this SALT cap deduction. So that's set to expire in 2026. Additionally, personal exemptions. So if you had exemptions, meaning children in the household, people that were dependents of yours, you got a deduction of roughly $4,000 per individual. So that's $4,000 of income that you basically didn't have to pay per individual. So a household of 5, that would be at $20,000 of personal exemptions. Personal exemptions went away. If the sunset occurs, they will come back. And then mortgage interest deduction. So the mortgage interest deduction was capped at $750,000. With the sunsetting provision, that will go back to $1 million. And also, you will be able to deduct interest on the first $100,000 of home equity debt. So there's some provisions that, some of us might look at this as this would be nice if these sunsetted. Some are going to be unhappy. Again, the jury's out, and so we're just going to have to be proactive in making good decisions in 24 and 25, but also just reactive to what happens in 2026 and adjust our planning. Okay, the next topic we want to jump into from a tax perspective is around planning considerations and strategies. So I'm going to, at a high level, when we talk about actionable planning strategies, so how do we maximize your popular deductions that are out there? How do we take advantage of lower tax brackets, right? So if you are in a lower tax bracket, whether it's on income taxes or capital gains, how do we take advantage of that? How do we look at estate planning under the new law, right? There are ways to preserve your step up in cost basis at death. There's a way to take advantage of the increased annual exemption amount, and then all the planning that comes as a result of the Secure Act, right? So these are all things that we already know we've been doing for clients the last several years. These are things that every year you want to look at because we know individual situations change, and a strategy that might have made sense a year ago or 2 years ago might not make sense this year. So it's really important that we adapt and that we look at every year by itself. We just got to the tax filing deadline, and I think probably more than half of our clients filed an extension just to have more time to get their ducks in a row. But the reality is we're going to start reviewing tax returns here over the coming months and helping us get ready for our 2024 planning. Okay, so as we go into, again, digging into some individual strategies, charitable giving is always a great way to reduce your taxes. Now, I've said this many times before, the reality is that if you give to charity, you're not better off financially, meaning if you give $100 and you save $50 in taxes, you still gave away $50 of your income or of your wealth. So the reason why you give to charity is to make an impact in the community. So your intentions of being charitable are important. It's important to our firm. It's important to me that we give to charities and support the community. But at the end of the day, it does give you a deduction. But if you're not charitably inclined, this is not a good strategy. This is for those who want to make the difference, want to make an impact, but also get a nice tax deduction. So a couple things that we do want to run through, and as you know, this idea of drinking through a fire hose, there's a lot of information. You start going through, how do I do charitable giving effectively? One of them is bunching donations. So the reality is a lot of taxpayers, based on stats that says only 18 million taxpayers are now itemizing, where it used to be 47 million. So that reduction of itemized taxpayers actually makes bunching donations way more effective. And bunching donations is very simply this. If you are not itemizing every year, itemizing your taxes, and you're giving, let's say, $10,000 to charity, you are technically not getting the deduction for that. So bunching deductions would say, okay, in 2024, instead of giving 10,000, I'm going to do 20. And then next year, I'm going to do 0. Then next year, I'm going to do 20. So essentially what you're doing is you're doing 20 this year, which is basically 10 for this year and 10 for next. You're just pre-funding it. And by bunching those donations, then you get credit for the charitable giving. So that's one way to look at it. If you have larger intentions to give to charities over your lifetime, using a DAF, which is a donor advised fund, to basically pre-fund your charitable goals. So if you're in a higher earning year and you want to get a larger deduction, you can make bigger donations into a donor advised fund Basically, you make a larger contribution into this fund, the money stays in here, and you get to give it out to the charities over, over your lifetime and even over your kid's lifetime. So we really we want to have you gift appreciated securities and what I call at your discretion, trying to optimize the price of when you gift an appreciated stock. And then these are really effective for giving to charities on a regular basis, like monthly, quarterly, or annually. Additionally, gifting appreciated securities versus writing a check. I can't tell you how many times people just write checks to charities, and there's a better way of doing it. So if this is you, I love the intent of giving to charities, but please stop giving it cash, stop writing checks, give appreciated securities. Here's a simple example of this. So if you gave $10,000 and you're in the highest tax bracket here in California, you're in the 50% tax bracket, your $10,000 gift goes to the charity. They get to have the benefit of that $10,000. You save $5,000 in taxes, and so your tax savings is 50%. However, if you decide instead to give an appreciated security, so this could be a stock, an ETF, a mutual fund, some sort of investment, it could be Bitcoin, right? Anything that is appreciated in value. Let's say you purchased an investment you purchased for $2,000. It has grown in value. It's now worth $10,000. So you have an $8,000 unrealized gain. If gifted instead of sold, you will save capital gains, and you're going to save the you're going to get your tax savings at your income tax rate. So this accounts for, trust me, I've done the math, a 78% tax savings in this example. Now, again, this is assuming you're in California at the highest tax brackets. And so you can see the benefit of doing this. And so I can't tell you how many times we talk about it. And it's like, oh, it's just easier to write a check. Well, there's a lot of, it is easier, but if it's going to save money, my attitude is, well, let's give more to charity then, because I would rather have this money go to charity than to the government. So there's a far more effective way of doing this. Another way is if you're giving to charity and you're over 70 and a half, so that's an important requirement, over 70 and a half, you can donate your IRA assets directly to a charity. This is known as a QCD, or a qualified charitable distribution. So the distributions must be sent directly to a qualified charity and can count towards your required minimum distribution, which is really powerful. Now, what are the benefits of doing this? Because it's essentially a tax-free RMD, right? Because you're giving directly to the charity, it lowers your AGI, which is your adjusted gross income. And this is really beneficial because it might have some benefits in the area of, I should say, tax areas of Social Security benefits, Medicare Part B premiums. And so lowering your adjusted gross income could have a huge impact, especially on Medicare Part B premiums, which we do this planning every year for clients. And so this is really a great tool to utilize, especially if you don't need your RMD. But again, this is if you're giving to charity and you're over 70 and a half and you're not doing this already, this is something that you should be adding to your 2024 list. Okay, one of the questions we get all the time is about Roth accounts. Now, one thing I want to tell you, because I hear this every time when I recommend people invest in a Roth 401k, let's say especially, oh, I make too much money, I'm not eligible to fund a Roth. And one of the things that's really important to know about Roths is that there are income restrictions for Roth IRAs. If you make over, these are a little bit of a guesstimate. I don't have these thresholds memorized, but I think if you make over about 150,000 individually and over 200,000 as a married filing jointly, then you're not eligible to fund a Roth IRA. However, you are still eligible, or may still be eligible, for a Roth 401k contribution and eligible for a Roth IRA conversion. So the income restrictions at this moment apply only to Roth IRA funding. So just know that these can be powerful tools that a lot of people think they're not eligible for because they have higher income. So does a Roth IRA conversion make sense? So this chart basically shows on the left and the right-hand side, 2023 tax brackets on the right-hand side, projected tax brackets, right? So the whole point of this chart is just to show you that if you are temporarily in a 12% tax bracket, a 22% bracket, or a 24% bracket, those are historically low tax brackets. That's kind of the sweet spot for doing Roth IRA conversions. Once you get up to about 250,000 of income, though, you do have this surtax that applies to married filing jointly, so you want to be mindful of that. But you can see this is a time where you might consider a Roth conversion. And I'm going to come back to an example here in a little bit, but that's why a conversion, we've been doing a lot more conversions recently because of these lower tax rates. As we start getting into a couple other things, the reason why we like the Roth accounts now, again, this is all dependent on your own personal financial situation, is that if we have higher taxes in the future, this is a great way to hedge that. And if you're in some of these lower brackets, you can see this top bullet point. It says this could be if you do a tactical Roth IRA conversion to top off tax brackets, or during years when income is lower or deductions are higher, right? So that's one of the things that you would want to consider. You might want to switch traditional 401k to Roth 401k. And also, the bottom bullet point is they've now just launched Roth contributions are now going to be allowed for simple and SEP IRAs. So, and I already had mentioned this prior, but since it's going to be a separate video, 529 plan rollovers to Roth IRAs. Starting in 2024, beneficiaries of 529 plans may roll over up to $35,000 during their lifetime to Roth IRAs. Let's see. They are subject to the annual contribution limits. This is a key thing. The 529 plan must have been open for more than 15 years. So it's really important, kind of, I think this just gives us the idea around we want to start early for our kids anyway. But it has to be open for 15 years to qualify for this. So the question, Roth IRA to convert or not to convert? Get this question a lot. Long term, there's a lot of benefits of doing that because your money can compound. Short term, you got to write a check, right? Because if you convert your Roth IRA, you got to write a check today. I actually did a small Roth conversion for myself last year, and I had to pay taxes on it. And so that's never very pleasant, but then you look at it and say, okay, if I pay tax today and I make good investments, then the money that I convert will grow over time, and now that'll be tax-free when I need it in retirement. So just some things to consider. So, the leave in the traditional IRA or the convert the Roth IRA. If you leave it in the traditional IRA, you maintain tax deferral as long as possible in exchange for taxable income in retirement. That's, you're signing up for that, right? When the money comes out in retirement, it's going to be taxable. Convert to the Roth, you accelerate your tax liability today in exchange for tax-free income. And one of the cool things as well is about the Roth is there's no required minimum distributions. So it allows you to be more tax efficient in retirement. And I like to utilize this illustration here because a lot of times I'll hear people who've been good savers over time, who have built up a healthy amount of money in their IRA, and also investments like real estate and other types of brokerage accounts, where they'll say, oh, in retirement, I'm going to be in a lower tax bracket. And, we start looking at their planning and their investing. And so I just want to walk through an example here. This is totally hypothetical, and it is using compounded growth rates, but this is a hypothetical example. But if at age 55, your IRA balance has $2 million, and you get an 8% growth rate between now and 75, which presumably somebody today at 55, your RMD age would be 75. Your IRA at that time would be worth approximately $9.3 million. That's without adding more money. That's just the compound effect of 20 more years of growth. And if you're having to take out 4% required minimum distribution, that's $372,000 of annual distributions. So that's going to be money you have to take out and pay tax on. So the reality is sometimes delaying and letting this compound in an IRA is not the best strategy. Additionally, there can be, this has tax ramifications from an estate planning perspective, because if you leave this to your children, they have some tax challenges of their own because they're forced to take out at a much faster clip. So just be thoughtful about this. So there's no perfect answer. It's not one's better than the other. It's just how your financial plan works. But when you look at some of these numbers, especially if you've been a good saver in your 401k and IRA, this is definitely something to look at now, because as you get closer to that age 75, you start running out of planning opportunities. Okay, so we're going to jump into some estate planning updates. This gets a little complicated, and it's a bit of an unknown because we don't have clarity because of where the tax structure, the tax code is today. So a couple things I just want to update you on. So annual gift exclusion. This is the ability to give to anybody on the planet, basically $18,000 each. So if you're a married couple, you can give up to $36,000 to each child, grandchild, or whomever you want to give to. Again, when you make these gifts, you do not get a tax deduction. But the person who receives the gifts, the person who receives the gift does not have to pay income tax on this or any sort of gift tax. This is really impactful when you have larger estates where people are trying to basically gift to their children and grandchildren. But it's just also a really helpful tool if you're trying to help a child with buying their first home or some different obligations. But this number goes up every year. It went from 17,000 to 18,000. So let's run through some estate planning considerations. One of the things is, as we're getting into the election year, we've been already kind of warning clients that 2025 is going to need to be an estate planning heavy. We're going to have an estate planning heavy conversation. There will likely be, we're going to need to meet with your attorney to make sure that your existing trusts is relevant, still works based on your net worth. So, we've kind of hesitated. We don't like to always wait till the year before the changes, but we're also fearful that if they make some big changes in Congress, then we don't want to waste our energy in 2024, based on changes that might be occurring in 2026. The other thing you want to be mindful of is, in California, we currently don't have any state death taxes. But in other states, they do, like the state of Washington. So that's something that you want to be mindful of. Some things as well, we see a lot of family members will gift assets to their children. And you have to be careful there if you have what's called low cost basis property. There's some real downside of doing that. So, one of the things that we really encourage our clients to do is get your team together. And that will be your advisor, which hopefully is us, and your estate planning attorney, and make sure you're making good, well thought out decisions. Because we have seen over the last 10 years where somebody made what they thought was a good decision, but in hindsight, it was a poor one because they gave away assets, parents passed away, and it really messed up the estate, and it cost them hundreds of thousands of dollars, which we want to avoid. The second to last bullet point here says high net worth families may want to consider a gifting strategy for the additional lifetime exclusion amount. So I'm going to explain a little bit of what that means. But again, the last note on here is we're going to need to work with your estate planning professional dealing with the potential sunset of the law in 2026. So here's a graphical interpretation of where the estate exemption is going. So in 2023, the exemption amount was $13 million per individual, and it's expected to go in 2026 down to $7 million. So that means there's this $6 million additional gift exclusion that you could give away during your lifetime. Now, you wouldn't want to give it away if you needed that money to live off of, but by giving it away, if this sunset occurs and the rates drop down, the exclusion drops down to $7 million, and your estate potentially would save over $2 million of estate tax because of this. So there's definitely a big opportunity here for larger estates. It can get challenging when you're talking about giving away portfolio assets. You can't give away IRAs, real estate assets. So this is not an easy decision, but it's one that should be on your radar, because estate planning attorneys are going to be busy. So again, once we know the result of the election, it'll probably be time to start planning. There's also something that they put in place for retirement accounts. So the idea of a stretch provision is no longer valid anymore. So what that used to mean is that if you left your IRA to your child, they could basically take equal payments or they could stretch out payments over their lifetime based on their life expectancy. Well, now that provision is gone. Now, spouses can still stretch these out, meaning they can still take it out over their lifetime, but children and other beneficiaries cannot. So the reason why this is relevant is there's now a 10-year rule. So in my example on a prior page, I showed on the Roth conversion page where what if your IRA grew to $9 million and you had one child that inherited that? They'd be responsible for taking that $9 million out over 10 years. So you can imagine that would result in a really large tax liability. So a couple of just things to keep in mind. This is another great example as you're building assets. Is like, does it make sense to do Roth conversions, right? When the account owner is living, so that you can limit this exposure to the estate later. And so And then also planning if you are a beneficiary of, so like we have clients who've been beneficiaries of IRAs, and we're trying to help them plan. Like if they're still working, the idea of taking money out of their IRA, they don't love it because they got to pay taxes at a much higher rate. So then we're putting together plans of say, okay, well, let's maybe not take any money out the first 5 years, knowing that we'll have to take money out the last 5 years. So being thoughtful about this is really, really important. There's also an advanced strategy that maybe you consider is you could leave your IRA to a charitable remainder trust. There can be some tax advantages around that. That's a good conversation with your tax professional, with us, with your estate planning attorney, especially if you're charitably inclined. And, we all know that most people focus on estate planning around the taxes, but estate planning is more than just the tax liability. Again, it's with your wills, your beneficiary designations. It's really critical to review and update periodically. So making sure your documents are still relevant. I just have, 2 daughters that are off in college and they're no longer minors. And so oftentimes, a lot of older trusts were built to accommodate minor children and having guardianship in there, and just different people involved with your trust. Once your children become adults is one thing. Once they become responsible adults is another. And that's where you might want to make some changes in your estate planning documents. But, these are the things you want to be updating: your living trust, your healthcare and medical directives, power of attorney, things like that. These are things that you should be looking at every 3 to 5 years or so. That's kind of what a typical estate planning attorney will recommend. But especially if you have some of these life-changing events that are coming. And then again, if your estate's large enough, being prepared for that is going to be a must. So it will be a must do for 2025. So closing thoughts on this sections again. So, the reality is we have been living through a pretty favorable tax policy, and we're likely going to have some higher taxes in the future, depending on what tax bracket you fall in. So we're big proponents of trying to get ahead of that and be thoughtful about planning strategies. And then I already just kind of wrapped up on, when you're working with professionals, really understand your income and estate tax planning strategies. That's where we come into the picture, is really help from the planning perspective, because we truly feel we're in a unique setup. We know your financial goals. We've mapped out your cash flow needs. And so we're a great resource to work with these other professionals, because we really understand what your financial goals, and we understand the nuts and bolts, and we understand all the numbers when it comes to your financial plan. And so being thoughtful about this is critically important. So hopefully this was helpful. So a couple quick things, because I'm gonna do like a little bit of a natural stop here. So if any of you are prospective clients, we kind of have 2 options. If you want to connect with us, we can take you through our new client process, where we'll do a discovery and clarity meeting, where we'll just basically kind of walk you through and help you build out a financial plan and see if we can be of assistance, kind of give you a second opinion on what you're currently doing. That's option 1. That's a little bit more thorough of an option. If you just want to have kind of a tax return review, we have a tax software that we can help out with. We can review it, things like making sure you're not missing deductions and you're making smart decisions. So that's really, if you want to reach out to our firm, those would be the 2 approaches that I would take. So we're now going to pivot into business owners. So I know I still have a few of you hanging on here, and because that was a little bit over about 50 minutes. And so I'm going to run through our consideration for business owners, because it's a different topic, right? We all have to file a personal tax return. So we have personal strategies that applies to everybody. When you're a business owner, though, you have other returns, right? You might have an S Corp return, a C Corp return, an LLC. You have different types of tax returns. So there are considerations that business owners have that not everyone else has. So this focus is going to be on considerations for business owners. So at a high level, we do have a tax philosophy here as well for business owners. Key ideas: pay yourself a market-based wage. That's really important. Too often we say business owners are not paying themselves a reasonable compensation, and that has a ripple effect through all the planning. So we want to make sure you're paying yourself a market-based wage. Number 2, business owners, focus on being profitable. Don't just spend money to avoid taxes. I can't tell you how many times people will rush to make a decision at the end of the year to get a deduction just to avoid taxes. if you need the deduction, if you need whatever you're buying, an equipment, a vehicle, whatever you're buying or spending money on, if you need that to help grow your business, by all means. But if it's just for avoiding taxes, I hate it. Like, it's just a bad idea. Paying taxes is the goal. That's why you're in business, because that means you're making more money. So if you're taking the risk to be a business owner, the goal is to make more money, which by definition, you'll pay more taxes. Number three, be careful about accelerating deductions using Section 179. So again, if you're in the 24% bracket or lower, it might be best to pay the taxes now. Now, this is going to depend on a lot of things, like your current cash flow. Can you afford to pay the taxes now? But oftentimes, what I hate seeing is that as people are building their business and they're in lower brackets, they accelerate their deductions to get the write-offs today. And then in future years, when their income jumps and now they're in a 32% bracket, or a 35% bracket, or a 37% bracket, they don't have those deductions at those higher rates. And that's when I want to use them. So those are kind of our key ideas of just be mindful around this. And again, we take the same approach with business owners, is we want to make sure we lower their lifetime tax liability, not in any one given year. Some of our big solutions that we help our clients with: payroll optimization, and I have a few slides on this. Adding spouse or children to payroll, retirement plan design, how to effectively do that, and creative strategies like the Augusta Rule. So this is just a summary layout of some of the different strategies, effective planning strategies for business owners. So the Augusta Rule strategy, which is the second one over from the left, is IRC Section 280AG, and basically it allows you to rent your house to the corporation up to 14 days tax-free. And that oftentimes can save about $10,000 to $25,000 in tax savings. Payroll optimization by hiring spouse and children and doing a reasonable compensation analysis. That'll save $5,000 to $20,000, depending on how many children. And then retirement plan design can really run the gamut of, between $7,500 and over $100,000, depending on the types of plans that we look at. So by being purposeful in these three areas, the tax savings can really add up. And again, it's being thoughtful about how do you implement them. So that was a summary overview. I'm just going to go through real quickly. You can see on this slide. So basically the ability of a homeowner to rent their house out to their corporation, and with the business purpose of doing what we call a planning day. And you can see on this example, and this is not a recommendation necessarily of the daily rate, because you need to get a comparable daily rate. But if you rent your home out for 14 days at $3,000 per day, that would create $42,000 that could be deducted from your corporate tax return, lowering your income by $42,000. And if you're in the 40% bracket, that would save about $16,800 annually. So essentially a tax-free distribution out of your company. However, there has to be a business purpose. You have to do documentation. So there are hoops to jump through, but it's a great planning strategy, especially if you will embrace this idea of a monthly planning day. The next option on here is payroll optimization. Again, there's, looking at the idea of adding spouse to payroll. You can substantially increase your retirement plan contributions, which can save taxes. Also, adding your children to payroll who are doing work in the business. A lot of times we see that as, junior high, high school, college. That's when children will get involved with the family business. Obviously there's big value to the children, benefits at working at a young age, benefits of understanding the family business. And then from a tax perspective, you get some deductions there as well. And, it's around $5,000 per child per year in tax savings. So there can definitely be some benefit there. And, again, then we get into retirement plan strategies. One of the benefits of obviously having spouse and children on payroll is for your spouse, you can max fund profit sharing. You can consider funding a Roth 401k potentially for you and your spouse, which, means you could put over $60,000 per year in Roth. For your children, you have the ability to have that earnings paid directly for college, maybe go into a 529 college account, or even, I think one of my favorites is the ability to fund a Roth IRA early in life. We did some math that said if you funded a Roth IRA for your child at $6,000 per year from age 16 to 22, so a 7-year funding window, that at a reasonable growth rate or market-based growth rate, that they would have over $2 million by the time they're in their mid to late 60s. So pretty powerful stuff. Again, a lot of the business strategies, we just want to be more purposeful about the decisions that we make. I hesitated to have this slide up here, There's something in the current tax code called a QBI deduction, which is a qualified business income, which basically means that 20% of your profits from your business might be eligible for a deduction, which means essentially that 20% would be tax-free. Now, there's a bunch of different nuances here, and I'm not here to necessarily make you an expert on this, but it's really important to know, do you qualify? And it's based on a few things: the type of business you're in and the amount of income. So if you're in the right business, it doesn't matter how much income you make. There is limitations based on how much you pay yourself. That's why doing paying yourself reasonable compensation and analyzing that's really important. If you make too much income and you're in the wrong type of business, then you basically will get phased out. So the long and short of this is really important to know where you stand, because there's tons of planning techniques. I have multiple case studies on scenarios. I'm going to give you two. So we had one of our clients came in. It was after the year was over, and had a really good income year based on the industry he was in, did not qualify for this deduction. And so we actually set up a cash balance retirement plan. He was able to put over 100,000 in the plan and made him eligible for the QBI deduction. So he was able to save over 60% in taxes on that example. Now, again, that's just one example. We also had a prospective client came in. I reviewed their taxes for them, and the accountant prior did not pick up that he was eligible for a QBI deduction. This was a high earner. He was making $3 or $4 million a year. And basically I looked at the tax returns. I'm like, something's wrong here. You're not getting the QBI deduction. So long story short, went back, a new CPA reviewed tax returns, last 4 years, could only amend the last 3, and it was over $600,000 refund because the wrong profession was selected for QBI. So we don't find that kind of a mistake that often, but it was definitely one that was worthwhile mentioning because we do catch this stuff. So QBI deduction is really powerful, and there are ways you can navigate it, especially if you're in a higher income situation, but that's where the thoughtful planning comes in. Other thoughts for business owners. So good example is if you have a business where you're going to have what's like a large net operating loss, so you have a down income year. One of the things we love doing is we'll do a Roth conversion. We had a client last year who was going to have a big operating loss, and so we were able to convert over $1 million on his Roth without any taxation because he had that loss. Now, there's probably some nuances that's not perfect, so it doesn't work in every situation, but the reality is he was able to convert over $1 million in the Roth, and he could use the operating loss to offset this. Again, that's a really important conversation to have with your tax professional, but obviously that's really powerful because that money will be able to compound, over the next 20, 30 years. The next bullet point on here is in California, we have something called the PTE tax, which is the pass-through entity tax. So basically, California put in place that since there's this cap of $10,000 on state and local tax, that you can pay your California taxes that would be owed based on the profit of your corporation from your corporation. And by being able to make that tax payment from your corporation, it reduces your taxable income at the federal level, therefore saving federal income tax. So real simply, let's just say you owed the state of California $80,000 because you had a business that earned $1 million. You pay that $80,000 from your corporation, and assuming you're in the 37% tax bracket, you're going to save, north of $30,000 in federal tax. We've seen this get missed a lot of times where we'll have prospective clients come in and, oh, are you doing the pass-through entity tax deduction? And it's kind of a deer in headlights, not really sure what that is. We go through it with them and they're not doing it. So we're not seeing that as much. Hopefully it's not anyone on this, listening to this video or on this webinar, but it's definitely something that we're seeing, that it's just, staying on top of these issues. And then again, something on the horizon is, Congress has discussed imposing a 3.8% surtax on S-corp profits. So is that something on the horizon as well? Okay, closing thoughts, essentially the same as on the personal side. Again, we've been in a pretty favorable tax policy environment. Really want to make sure we're making the right decisions to hedge against future tax increases. Again, be careful about accelerating deductions now because we might be going into a higher tax environment in 2026. Make sure you work with your tax professional and estate planning team to make sure you implement the proper strategies for your business and for your personal needs. All right, so last thing is anyone on this call who would like a complimentary consultation with one of our wealth advisors, go ahead and scan the QR code or visit our website to book an appointment. A couple things on a webinar. So our next live webinar is going to be July, which will be our mid-year economic and market update. So that's the mid-year where we give a market update, what's happening in the stock market, economic, updates with the Fed, all the things going on in the world. And I've been doing those for over 20 years. So that'll be in July. May and June, just stay tuned for videos on demand. So given that this webinar was quite long, we've decided that there's content like I'm going to do a short video on like Bitcoin and cryptocurrencies and just some different topics. So we're going to use May and June as videos on demand that'll be delivered to you through social media and through email. So hope you enjoyed. I really appreciate it. It looks like I had actually the majority of you guys stay on for the duration of the call. So I know tax planning is not the most exciting topic. Hopefully you can see from my smile, we do enjoy this here at Vance Wealth because we truly feel we can make an impact and help save money for you, put more money in your pocket, or use that money to make a bigger impact in the community. So thank you very much. Have a great night.